Welcome, everybody, to the second day of the Qatar Center for Global Banking and Finance conference. Yesterday, we had an engaging day with lots of cutting-edge research and interesting discussions on the future of monetary policy. I'm expecting another very interesting and engaging day today. But before we start with our keynote address by Lord Macpherson, let me hand over to Professor Evelyn Welch, Principal of King's College London, for some remarks. Evelyn, the floor is yours.
Thank you, Francesca. It's my great pleasure to join Francesca and the team in welcoming all of you to the second day of this inaugural annual conference of the Qatar Center for Global Banking and Finance at King's College London. I'm pleased to say that thanks to the miracle of Zoom, we have a truly global audience for this event. Amongst the almost 250 to 300 virtual attendees for yesterday's discussions were participants from over 70 different countries. This is really important because today's challenges are truly global. The issues we face in societies are absolutely cross-border boundaries, be it recovering from the pandemic or tackling the climate emergency. And facing up to these challenges will require global cooperation. We need to really move beyond global competition. It's precisely through events like this, through talks like you're just about to hear, from the questions that you ask, where we gain fresh ideas that will improve the lives of people around the globe. I'd like to take this opportunity to say how very grateful I am, how very grateful we all are to Qatar Central Bank for the strategic vision that they had in setting up this centre and for their friendship, guidance and investment in its development thus far. I had the pleasure of visiting Qatar Central Bank and meeting with His Excellency, the Governor and colleagues. It seems so long ago now, in October 2019, at the beginning of this partnership. And I'm sure that all of you participating from Doha will be very proud of what we've been able to achieve together, what we've been able to do in terms of creating links across academia, the central banking community, and those working in the financial sector, be it in the City of London or elsewhere. And we are truly excited about the ideas and challenges that we will hear about today. So Francesca, I'll pass back to you to introduce Lord Macpherson for the keynote address. Welcome, everyone.
Thank you very much, Evelyn. Before I introduce Lord Macpherson, let me do a couple of points of housekeeping. So first of all, for all of those who are listening, please ask your questions via the Q&A box on the Hoover platform, and we will make sure that we can, ask them, relate them to our speakers. Also, please check out the posters in the poster session area, both of the people presenting the posters and also the videos from the PhD students shortlisted for the Young Economist Prize, the winners of which will be announced later today at the end of the conference. So now, let me say I'm delighted to have Lord Macpherson here to speak to us about the relationship between Her Majesty's Treasury and the Bank of England, the search for credibility. Lord Macpherson doesn't need any introduction. He was permanent secretary to the Treasury from 2005 to 2016. He served 3 chancellors and indeed was leading the department through the economic crisis of 2007, 2009. So without further ado, Nick, let me hand over to you, please.
Francesca, thank you. And let me say how good it is to be at this much delayed, but finally happening annual conference. And can I also say what a good thing it is that Qatar has sponsored this centre at the King's Business School. That's great news for King's. So over the last year, quantitative easing has entered a new phase with apparently coordinated announcements of unprecedented increases in government spending and asset purchases. This has intensified the debate about where monetary expansion will end and whether, and if so, how quantitative easing will be unwound. It has raised questions about how independent central banks are from government. Are they slowly being traduced by the seemingly snake-like embrace of finance ministries? Today, I'd like to examine the relationship between central bank and finance ministry. I'm going to do so by focusing on the institutional relationship between Her Majesty's Treasury and the Bank of England. I recognise that many of you come from other countries, and so if this appears a little parochial, apologies. But I believe Britain's experience does have wider application, even when the central bank is transnational, like the European Central Bank. I shall seek to argue that the relationship has been evolutionary, that the Bank of England's legitimacy rests as much on how it exercises its power as the statutory framework of the day, and that the wider the central bank's remit and the more fiscal policy and monetary policy become entwined, the greater the risk to its independence. But first, a little history. The Bank of England was founded in 1694 to help provide the loan finance for the war with France. It was essentially a private institution set up under a royal charter. Its original subscribers included King William and Queen Mary, as well as the First Lord of the Treasury. It was only with the passage of time and successive charter renewals that it began to take on the role of a modern central bank, in which role it was independent of and at arm's length from government. But consistent with the objective in its original charter to promote the public good and benefit of our people, it tended to work closely with government when circumstances warranted it. At times, the Treasury would effectively overrule it. A good example is the banking crisis of the summer of 1914. The Bank of England reacted to the run on the banks then by raising interest rates from 3% to 10%, straight out of the 19th century central banking playbook. John Maynard Keynes came down to London in the sidecar of his brother-in-law's motorcycle to form part of Lloyd George's emergency Treasury team, and immediately observed that high interest rates were undermining rather than restoring confidence. Lloyd George took charge, and following a 4-day bank holiday from the 3rd to the 6th of August, during which Britain declared war on Germany, announced a month's moratorium on payments of bills of exchange, and more importantly, the printing of £1 banknotes by the Treasury. Of course, the bank was still independent. It was the court, its board, which appointed the governor, but increasingly it had to understand the limits to its independence. For example, in 1917, when the then governor Walter Cunliffe tried to block the Treasury from issuing instructions on the movement of Britain's North American gold reserves, Lloyd George, by then Prime Minister, summoned Cunliffe to Downing Street and threatened to take over the bank. Cunliffe had to write a grovelling apology and was subsequently not reappointed. Montague Norman may have bestrode the interwar years like a central banking colossus, drawing on charisma and mystique in equal measure, but he also had to recognize political reality. When he sought to push up interest rates for a second time in 3 months in July 1920, he was informed by the then Chancellor Austin Chamberlain that another rise was politically impossible. Interest rates, observed Norman, are now a political as well as a financial question. And later, after Britain had come off the gold standard, Norman could state to a meeting of the Empire's central banks, "I am an instrument of the Treasury." That is not to say Norman could not be an irritant to the Chancellor of the day. Winston Churchill never forgave him for his advice to return to the gold standard at pre-war parity in 1925, but it does underline that the relationship between the bank and Treasury has tended to be evolutionary rather than revolutionary. On the face of it, the nationalisation of the bank in 1946 and the granting of operational independence in 1997 look like seismic shifts, but in practice they were rather less seismic. They were regularising what was increasingly common practice. The 1946 Act gave the government the right to appoint the governor and to set interest rates through a general power of direction. But Norman's successor, Thomas Catto, had been appointed because the then Chancellor valued his worldly knowledge as to affairs in general, and especially as to Whitehall. And there would have been no question by that time of the bank changing interest rates without the Treasury's agreement, not least because of the latter's responsibility for macroeconomic policy under the new Keynesian consensus. Similarly, operational independence of the bank granted by Gordon Brown in 1997 was facilitated by a succession of reforms put in place following Britain's exit from the exchange rate mechanism of the European monetary system in 1992. First, the introduction of inflation targeting, with the objective of keeping underlying inflation within a 1 to 4% range. Secondly, the publication by the Bank of England of a quarterly inflation report, which provided a projection of underlying inflation over a 2-year forecast horizon. And thirdly, a regular cycle of monthly meetings. And finally, from 1994, the publication of the minutes of those meetings, including the opening statement of the Governor of the Bank of England. In many ways, this framework, which was hammered out by Treasury and bank officials, prefaced the monetary framework which is still in place today. I speak from experience because, as Ken Clarke's private secretary, I attended all the monthly monetary meetings for which minutes were published, including the penultimate one at the HMRC office in Nottingham during the general election of 1997. This is etched in my memory because Ken had wanted the meeting to be at the rather more salubrious surroundings of Trent Bridge Cricket Ground, but the then Permanent Secretary Terry Burns put his foot down since it was in Ken's constituency. The Ken and Eddie show, as it became known, provided a certain amount of entertainment for the media. As Ken predicted to me shortly before the minutes were published for the first time, it made a national figure out of the governor. Of course, the Chancellor still set interest rates, often at a level which was inconsistent with the advice of the governor. And at times, the governor showed his frustration. "I don't know why I bother," he remarked on one occasion as he was driven back to the bank. In general, the pair was seldom radically opposed in terms of what they wanted. Eddie and I never got more than 25 basis points apart, Clarke would recall. These changes were introduced against the background of the passing of the Maastricht Treaty, which committed governments to making their central banks independent as part of stage 3 of economic and monetary union. Ken Clarke saw a strong case for moving to stage 3, providing the convergence conditions were in place, but he was not attracted to making the central bank independent until that time. Now, New Labour won the 1997 election on a manifesto which was Delphic on the party's intentions for the central bank. It therefore came as some surprise on the day Gordon Brown arrived in the Treasury that he made clear to Terry Burns, the Permanent Secretary, and to me, his private secretary, that he intended to make the Bank of England operationally independent on the basis of a plan largely developed by Ed Balls, now a fellow professor at King's College London. But what did the 1997 model look like? First, consistent with the theme of constrained discretion of the time, it fell to the government to set the inflation target through an annual remit, initially 2.5% using the RPI-X measure, latterly 2% using the Consumer Price Index. The target was symmetric. If the bank missed the target by more than 1% in either direction, the governor was required to write an open letter to the Chancellor setting out the reasons and how the bank proposed to get inflation back to target. As Mervyn King noted in a lecture in late 1997, the distinction between goal independence, in which the central bank chooses both the target and the instrument, and instrument independence, in which the central bank sets interest rates and the elected government sets the target, is an important feature of our system. Secondly, legislation provided for the composition of the Monetary Policy Committee, comprising the governor, 2 deputy governors, 2 bank executive directors, and 4 externals appointed for renewable 3-year terms. The Treasury's power of appointment of the majority of the committee gives it considerable influence, and the relatively short terms of the externals arguably increases its scope to influence the decisions of the committee. Though there is no evidence to suggest that the Treasury has ever sought to pack the committee, or that deputy governors or external members' behaviour has been influenced by a desire to be reappointed, this could change if a populist government wished to exert pressure on the bank. The MPC was to take decisions on the basis of one member, one vote, which underlined individual as well as collective responsibility. A Treasury representative also attended meetings to ensure the committee was briefed on fiscal policy developments, and the Chancellor was kept informed of monetary policy developments. As Mervyn King made clear in the same lecture, one of the contributions of the new Monetary Policy Committee is to provide a forum in which ideas and information can be pooled. This is the optimal response to decision-making under uncertainty in a world in which no one individual has a monopoly of wisdom nor of information. And the new MPC has led to a sea change in our discussions on inflation. MPC members would regularly appear before the Treasury Committee in Parliament to reinforce accountability. And although the committee did not have a veto on appointments to the MPC, it could make life uncomfortable for the government and the individual if it made clear it disapproved of the appointment. However, as important as its monetary remit were the other changes implemented in 1997. First, operational responsibility for debt management, which had been a core function of the banks going back to its foundation, was transferred to the Treasury, which in turn set up the Debt Management Office. Secondly, arrangements for banking supervision were fundamentally reformed, with financial regulation put on a statutory footing. The bank retained a general responsibility for financial stability under an additional deputy governor. But prudential supervision was transferred to a new agency, the Financial Services Authority, which was also responsible for conduct regulation. The latter was opposed by the then Governor Eddie George, but in the context of the time, it was understandable. The Bank of England's record on prudential regulation had been patchy through the secondary banking crisis of 1973-74, the collapse of Johnson Matthey in 1984, and BCCI in 1991. The Treasury had concerns about information sharing and a perception that the bank was too inclined to intervene. Given regulatory failure was more or less inevitable, there was a risk it would undermine the legitimacy of the bank in its new monetary policy role. It was also possible that prudential responsibilities could distort monetary policy decisions. And there was lingering concern that if the bank retained responsibility for prudential regulation, it would become overmighty. The bank's role between the wars still played a role in Labour Party mythology. The 1997 reforms were successful. The Bank of England raised its base rate significantly from 6.25 to 7.5% in the year following independence, causing sterling to strengthen. And for a time, the Conservative opposition opposed independence, hoping to exploit public dissatisfaction with higher interest rates and their impact on manufacturing industry. But the policy worked, at least in broad terms. Inflation expectations fell significantly following the announcement in 1997 and have remained broadly anchored ever since. In a service-dominated economy, the impact on manufacturing industry mattered far less than in the early 1980s. More importantly, underlying inflation fell towards the target, helped by the impact of globalization. The increasing role of China in supplying consumer goods to the industrialized West caused significant disinflationary pressures. The economy continued to grow quarter after quarter. It's little wonder Mervyn King came to describe this period as the NICE decade, where NICE stood for non-inflationary, consistently expansionary decade. With Eddie George's departure, the bank began to make a virtue of its narrower remit, focusing on monetary policy while reducing the resources it allocated to financial stability. Increasingly, the in-house view seemed to be that the Financial Services Authority had the power and the instruments. Why should the bank waste resources shadowing it? As we know now, this was a period when risk was building up in the system. There is a tendency for all of us who had a position of responsibility pre-crisis, and I should declare my interest as Permanent Secretary of the Treasury from the summer of 2005, either to argue that we predicted it, citing an obscure statement from that time, or to explain why it wasn't our responsibility. Neither position, in my opinion, is sustainable. The fact is, there was a massive intellectual error about the build-up of risk and a fundamental lack of preparation for the consequences of that risk coming to pass. The early events of the financial crisis, speaking from experience, were painful. As the run on Northern Rock got underway, it became clear that the Bank of England's provision of emergency support to a bank no longer provided enough reassurance to depositors. Looking back at that time, the Treasury was slow to recognise that Northern Rock had to be nationalised. The FSA had been slow to recognise that the Northern Rock business model was unsustainable and that the banking system as a whole was undercapitalised. And the bank was slow to recognise that the provision of greater liquidity might represent part, if not all, of the solution to the banking crisis. The focus on moral hazard in the bank's memorandum to the Treasury Committee of September 2007 comes to mind. But when the wider banking crisis struck in October 2008, the so-called tripartite authorities generally worked well together, and their solution to the crisis, a three-point programme involving recapitalisation, a special liquidity scheme, and a credit guarantee scheme, became the model for resolving the banking crisis across the world. The banking crisis led to two critical changes in the relationship between the Treasury and the bank. First, because the Bank of England's balance sheet was insufficiently large, it led to the widespread use of Treasury guarantees and indemnities to support central bank interventions, whether to underpin emergency liquidity assistance, the special liquidity scheme, or quantitative easing. In each case, the Treasury was careful to leave operational decision-making to the bank. And in the case of QE, the Chancellor made clear that the government would not alter its issuance strategy as a result of the asset transactions undertaken by the bank. The bank pressed for more capital, and in June 2018, the Treasury appeared to accept this argument, injecting an additional £1.2 billion into the bank's balance sheet. Arguably, this was merely a gesture. It allowed the bank to finance the term funding scheme then in operation without a Treasury guarantee, but this was small beer. On any significant intervention, for example, QE, the bank is still dependent on a Treasury guarantee, or in the case of last year's corporate finance facility, has little choice but to act as the Treasury's agent. More generally, the post-crisis arrangements have changed the way the Treasury and the bank work together, involving a more regular and intense dialogue. Before 2007, the bank tended to keep the Treasury at arm's length, lest its operational independence be diluted or even polluted by too closer contact with the political arm of economic policymaking. The financial crisis gave rise to a more mature relationship where the bank institutionally seemed to recognize that there were a number of issues where it might be able to secure a better outcome if the institutions cooperated more. Certainly, I found, talking to my opposite numbers in Australia and Canada, that some countries had navigated the financial crisis without too much tension between the central banks and finance ministry. It would be tempting to put this down to personalities, but I would put it down to different institutional traditions and history. Mark Carney seemed to find it easier to work with the Treasury, though some would say he may have gone too far in doing politicians' dirty work, for example, through his interventions in the referendums on Scottish independence and membership of the European Union. Mind you, Mervyn King had had his critics too. Some perceived he'd gone too far in his public utterances on fiscal policy before and after the 2010 election. The second big change which came out of the financial crisis was institutional. Neither the Treasury, nor bank, nor Financial Services Authority came well out of the crisis, but the Conservative Party found it convenient to lay the blame at the door of the newest institution, itself a creature of the Labour government, the FSA. The incoming coalition government therefore decided to abolish the latter, restoring prudential regulation to the Bank of England in the form of the Prudential Regulatory Authority, and creating a Twin Peaks model with conduct regulated by a new institution, the Financial Conduct Authority. The coalition reforms also provided an opportunity to create a new instrument of economic policy, macro-prudential policy, with the creation of the Financial Policy Committee, whose constitution is closely modelled on the Monetary Policy Committee. Macro-prudential policy isn't new. In earlier eras, the bank had been happy to seek to influence banks' behaviour through reserve asset ratios and interventions such as the supplementary deposit scheme. But the creation of the FPC certainly made macro-prudential policy more transparent. The final set of reforms related to governance. The court was reduced in size, the chair's role was put on a legal footing, and an oversight committee was put in place to review the bank's performance against its objectives, with powers to commission reviews into specific issues or processes. The National Audit Office's remit was extended to carry out value for money studies of the bank. These changes were all about strengthening the Treasury's role as shareholder. More importantly, the financial crisis had raised questions of who was in charge in a crisis. Alistair Darling had considered using the general power of direction in the 1946 Act. However, this was seen as a nuclear option. As he put it, I was so desperate that I asked the Treasury to advise me as to whether or not we could order the bank to take action. The answer was that it might be legally possible, but there would be wider implications of such an action. We had set great store by making the bank independent, and a public row between myself and Mervyn would have been disastrous, particularly at this time. The 2012 Financial Services Act therefore gave the Chancellor a specific power of direction in a crisis under certain prescribed circumstances. On the face of it, the 2012 settlement was consistent with the long-term evolution of the relationship between the Treasury and the bank, and it looks fairly stable. Neither the government nor the Bank of England are pressing for radical change. But I would like to finish by focusing on two issues which could yet give rise to fault lines: the breadth of the bank's responsibilities and what happens when the interests of the Treasury and bank begin to diverge. It's worth coming back to why Gordon Brown took prudential regulation away from the bank in 1997. Regulating banks is a difficult business. Regulators spend a lot of time refighting the last war. And to the bank's credit, it has put a lot of effort into ensuring that a crisis like 2008 is not repeated. And you only have to look at UK banks' capital ratios to see that the banking system is a whole lot stronger than it was a decade or so ago. But the capacity of the financial system to evolve at a faster rate than the regulator's ability to understand it has been a recurring theme of the modern era. And sooner or later, there'll be another banking crisis or scandal, and as in 2008, the prudential regulator will carry the can. In one sense, this doesn't matter very much. The government can always rearrange the deck chairs once again and take prudential regulation away from the bank. But the risk is that the credibility of the bank will be undermined in the process, particularly if its actions on regulation appear to be in conflict with its monetary objectives. In a different context, Mervyn King has recently criticised the Chancellor's remit to the bank to take into account environmental sustainability when purchasing corporate bonds, arguing this is the first step on a slippery slope to undermining the independence of the bank. In short, there is a risk of mission creep. Moreover, the current system places a big premium on the judgment of the governor, who sits at the apex of monetary policy, macroprudential policy, and prudential supervision. This has led to some to consider reforms to the current framework. For example, had Labour won the 2015 election, the incoming Chancellor would have been Ed Balls, who had planned to beef up the role of deputy governors of the bank and the head of the Financial Conduct Authority in a crisis. Subsequently, he's argued for a wider set of government reforms to strengthen political oversight, including a finance ministry-led systemic risk body, which would set financial stability priorities and decide on the perimeter of permissible tools, and a more broadly based power of direction of independent agencies in a crisis. The other test of the current regime will be when the Treasury's and banks' objectives come into conflict. So far, since the bank became operationally independent, there have only been two brief periods of tension. In 2007-08, when the Treasury wanted the bank to play a more advanced role in the provision of liquidity, and 2009-10, when the governor appeared to be arguing for a tighter fiscal policy than the then Labour government was prepared to adopt. Generally, monetary policy and fiscal policy have been aligned, and even when they haven't in the austerity era between 2010 and 2015, there was agreement, at least between the Chancellor and the governor, that tight fiscal policy would facilitate looser monetary policy. During this year of coronavirus, both monetary policy and fiscal policy have been loosened to a degree which is pretty much unprecedented. The Bank of England doubled its asset purchase programme from 435 billion to 895 billion and will soon own some third of Britain's national debt. The bank has also raised the possibility of negative interest rates. In theory, this is the continuation of current policy by other means, but I wonder how acceptable it would be to the government if it led to a pensioner revolt and further impaired the operation of the banking system. But the more interesting question is what happens when the bank seeks to tighten policy. As Charles Goodhart has observed, in a fundamentally disinflationary context, fiscal and monetary policies will always go hand in hand. Central bankers and ministers of finance have been best buddies for decades. The problems arise when the situation shifts and you get into an inflationary setting, and ministers of finance and central bankers, each pursuing different objectives, find that they come into more conflict. The Treasury was happy to pocket the profits accrued by the asset protection facility as interest rates fell, but we are now at an inflection point. As the OBR and others have noted, QE has effectively shortened the tenor of government debt, with the result that a rise in interest rates will rapidly feed into debt interest burden. The OBR has estimated that if interest rates were 1% higher across the yield curve, the debt interest burden would rise by some £21 billion, that's 0.8% of GDP by 2025. This has led some to argue that the Bank of England should remove the link between bank rate and the rate at which clearing banks' reserves at the Bank of England should be remunerated. And I foresee parliamentary support for this. Using taxpayers' money to buttress the bank's balance sheet, the better to remunerate clearing banks' deposits, is likely to be a hard sell. Clearly, ministers concerned with maximising fiscal headroom may choose to jump on this bandwagon, and they may seek to apply pressure on the Bank of England. But in my view, the Chancellor needs to be very careful. For policy to remain credible, it needs to be symmetric. The Treasury was happy to reap the fiscal benefits of QE when policy was loose, but when the bank begins to tighten policy, it should be prepared to live with the consequences. That was, after all, the implicit deal in the exchange of letters between Alistair Darling and Mervyn King in 2009. The problem is that none of us involved in those original discussions ever anticipated that QE would go on for so long and reach such elevated levels. Here again, there may be scope for institutional reforms to bring some of these tensions to the surface and make the relationship between the Treasury and bank more transparent. Bowles has suggested the creation of a coordination mechanism between central bank and finance ministry. But as he argues, this needs to be initiated by the central bank in order to protect its independence, and the government should have a veto in order to maintain democratic control over fiscal policy. In the meanwhile, a measure of the Bank of England's self-confidence will be whether the governor and MPC resist any pressure to rewrite the rules of the QE game. Clearly, from a legislative perspective, they're insulated, at least in the short run. But history suggests that the statutory framework is only one component of a 327-year relationship between the bank and the Treasury. What matters is how the relationship works in practice. And here, time alone will tell. Thank you.
Thank you very much, Nick, for a really interesting talk, which actually very well relates also to the keynote we had yesterday by Lucrezia Reichlin, who was looking at the future of monetary policy, looking at lessons from the EU, and she too was putting a lot of emphasis on institutional design as something that we need to think of in the future, in the sense that you know, the current mandate of most central banks in advanced economies is really based on, you know, this kind of narrow mandate and focused on a complete independence. But the current crisis has kind of brought up a lot of questions around the monetary and fiscal coordination. And indeed, there's some research from Leonardo Melosi and Francesco Bianchi. Leonardo Melosi had presented another paper of his yesterday, but they have a paper where they suggest that monetary and fiscal coordination, which was considered completely taboo until very recently, can actually be beneficial also to achieve monetary policy objectives if done properly. So they suggest a contingent sort of coordination, where during emergency periods, there's emergency budgets that you know, involve much more coordination, while in normal times, independence is you know, dominant. And so I wanted to get your view on this, and you know, on what sort of institutional designs you think would be most beneficial at this point, and whether this idea of having it contingent to the situation you think is workable in practice. And yeah.
Really interesting points. I do think it's worth considering, you know, developing a clearer institutional framework for these extreme circumstances where you need coordination of policy. I think the problem at the moment is that those discussions are quite opaque. Obviously, you know, the Chancellor, the Minister of Finance meets the Governor of the Bank of England regularly, but you know, that's behind closed doors. And so I think some sort of institutional arrangement which makes that relationship more transparent, I think would be helpful, because what you want here is an element of predictability, and you want to guard against you know, the Minister of Finance sort of leaning on the central bank governor. Now, where I have some doubts are around sort of efforts to, you know, identify an emergency sort of fiscal fund, in a sense, which the central bank could deploy. Because I think once you get into the sort of fiscal policy area, this really goes to the heart of sort of democratic accountability, and you know, I would want to be quite careful about the central bank sort of getting involved in decisions which have implications for the sort of taxation of the people. But this is definitely a fertile area which merits, I think, more debate and analysis, because I think recent years has shown that the sort of institutional arrangements put in place in the 1990s don't really answer these questions.
Thank you. So I see there's also some questions. So let me relate them. To you. So there's a question by actually David Aikman, who's asking if you can expand a bit on the idea of a coordinating mechanism and how that would work in practice, a coordinating mechanism between the bank and HMT.
Well, I think at the moment, all the discussions tend to be informal. So, I mean, to use an example, I remember on Alistair Darling's instructions, going around to see Mervyn King at the bank. I think with the then chief economic advisor, now deputy governor of the bank, Dave Ramsden, to discuss what we were planning to do in the budget in terms of fiscal expansion, the better to understand what the bank's reaction function would be, and so on. Now, that was all done in private. And look, I'm not saying that, you know, every single conversation should be recorded. Obviously, you do need a sort of informal space where occasionally you can just sort of throw ideas around. But I think having a formal mechanism where the positions of the two parties are recorded, I think that greater transparency would enhance the credibility of decision making. I mean, you kind of want, you know, both citizens and the wider markets to understand what is underpinning decisions, and you know, the greater clarity on that, I think the more credible policy becomes. Now, that doesn't really help you too much with the area I'm most concerned about, which is actually what happens when central banks want to tighten. But again, actually, if there is a forum where that debate takes place, again, I think that would be better than no forum at all, because, you know, as I say, I'm really very, well, I wouldn't say very, I'm sort of somewhere between quite and very worried that in the UK at least, the considerable pressure will be placed on the bank not to tighten policy because of the implications for the debt interest bill.
I mean, I think this also speaks a lot to the second question that we have here on the screen about, you know, this 895 billion of QE and how this is shaping HMT and the Bank of England's relationship, and the challenges.
I mean, we are, once a central bank becomes the biggest holder of government debt, which I think the Bank of England will become later this year, that's quite a difficult place to be. And as I said in my talk, none of us anticipated that QE would go on for so long and become so reach such magnitudes. And the problem, I think, it hinges on the fact that, you know, in the good times when yields were coming down, the Treasury effectively spent the profits of QE because there were profits. And my worry is it's going to be less happy to finance the losses, and this is going to be problematic.
And I'll ask you one last question before we conclude, maybe about the international comparison. So you were mentioning that, you had spoken with your counterparts in Canada and New Zealand, and that they had had an easier ride on this. And so I just wanted to get your sense of what you thought the evolution was in the UK compared to, for example, the US or the EU at the moment, and where do you think all these three countries which have different institutional setups, somewhat different, where they're heading?
Well, I think this is really interesting because I mean, the US by its nature is different, because if you effectively are sort of printing the reserve currency of the world, you have just far more freedom than if you're a country like the UK, which is very open and subject to, I mean, the exchange rate is far more important for us. So I think the US can basically get away with things. On the other hand, it does create problems for the rest of the world, like it did when it was financing the Vietnam War. And if the US pursues too inflationary a policy, we just don't know where that's all going to end. I mean, the United Kingdom has probably gone slightly further. I mean, Japan actually is way ahead of all of us. But the big difference between Japan and the UK is that Japan has a massive domestic savings market. The Japanese tend to save. The British are addicted to consumption, which means that we rely on other people's savings, or as Mark Carney once described, the kindness of strangers to finance our deficit. But I mean, in one sense, I think actually central banks and finance ministries across the world are actually pretty much in the same boat. I do think the transnational nature of the ECB just makes that relationship rather more complex, and actually the ECB therefore is more independent than, say, the bank is. But the lucky countries are the countries probably like Canada and Australia, which haven't actually done too much QE in the first place. Because I do think QE over time, I've likened it in the past to heroin addiction. You know, the more it goes on, the more you need, the more QE you have to do to have any effect at all. And I think the countries which have done the most QE are going to find the biggest institutional challenges when it comes to unwinding it.
Thank you very much for this really insightful talk. I think we're left with a lot of kind of food for thought, but also a lot of kind of additional information and things that we can mull over, and hopefully research will be kicked off with this. I see there's another question. I don't know if we want to take it now, because we're almost out of time. Shall we take one more question, or should we conclude? Let's take the last question. Sorry, because it just popped up, and then I'll close. So this is by Anastasia Layotti, who's asking about the criticism that the BOE exhibited an inability in explaining the effects of QE. And sorry, whether if you think this is a concern in your view, and if this is an issue in making QE more effective and so on.
Yeah, I mean, look, the Bank of England has done its best to explain the effects of QE. It's written many learned papers. And by the way, actually, all of you who are academics, this is a great time to be an academic. When I was growing up, macroeconomic policy was becoming really boring, but it's now really exciting. So please do some research. So the bank has done it's published lots of papers, but the fact is there are big uncertainties about the effects of QE, and I mean, look, sometimes you just have to accept that. I don't think it necessarily threatens the bank's independence, but what I would hope, not least through the help of academia and institutions like this center, that actually we're getting a much better evidence base with each successive year. And I would hope that your analysis will help improve the efficacy of policy in the future.
Thank you, and I cannot but echo this call for more research in macroeconomics. Thanks again for the wonderful talk, and I want to remind everybody that we have a very interesting session on central bank decision making and communication coming up at 11. So with this, thank you everybody, and see you soon. Thank you, Lord Macpherson.
Thank you.